We'll just wait a few more minutes to see anybody else wants to join, and then we'll be starting the webinar. Just bear with us a few minutes and welcome. Just had another group of people just join, so we'll wait and see another minute, and then we'll start the webinar. Frankly, the more interesting bit is after I stop speaking anyway, so we'll start that in a moment. And a very good morning to everybody, and thank you very much for attending our webinar this morning. I must say that I kind of hoped that we would be able to stop talking about Brexit relatively soon. Unfortunately, Brexit continues on and on, and the whole scenario around the UK's trading relationship with the European Union is evolving and evolving rapidly. If we can slick onto the next, onto the first slide, please, and possibly the second slide. That's brilliant, thank you. I think it's always worthwhile reminding ourselves when we're looking at the cooperation agreement and the relationship between the UK and the European Union, the context in which we're talking here. The numbers are very, very large indeed, and the UK numbers not significantly small either. So if you look at the EU side, the population of 448 million, obviously the UK 70 million is a decent chunk of that. The GDP of 13 billion, the EU 14 billion nearly, the UK with 2.5 billion. You're talking about an enormous amount of trade. And the reason I've put this up really is just as a reminder of the sheer volume of goods crossing between the EU and the UK and vice versa, which probably goes a long way to explaining some of the problems that were encountered by businesses trying to wrestle with the major fundamental changes that Joe will be talking about in a moment, against the backdrop of that kind of heavy movement. There was always going to be friction. It was always going to be difficult, and so it proved to be. Some difficult for more difficult than others. Many people were predicting that there would indeed that the biggest problem to trade would be the sheer volume of goods and the ability of business to assimilate those changes, and certainly that's what happened. Certainly, Joe and I had an enormous number of clients phoning saying, well, we've now got goods stuck here, there, or everywhere. We need to get these goods cleared, etc., etc. So yeah, it seems to have settled down a little bit now, and I think there is a little bit more understanding. However, the political backdrop itself appears to be still as confused as ever. If we move on to the next slide, we can start talking a little bit about the new agreement. So on Christmas Eve, a wonderful Christmas present from Boris Johnson, the Trade Cooperation Agreement. I say it was a wonderful Christmas present. It was for most business people. Wasn't fantastic for me because it was announced at lunchtime on Christmas Eve, when quite frankly I would rather have been doing something else other than reading this and drafting articles about it. But never mind. It's got to be it's got to be a bit of a record for trade cooperation, for trade agreements to be done in that period of time. But what I would say is that the cracks are showing, just as if you try and render plaster too quickly. When it dries, it cracks. There are an awful lot of things missing within this agreement that you would expect, and it doesn't reflect the detailed kind of agreement that you normally see in this kind of trade agreement. What does it cover? Well, it covers an awful lot about trading goods. That would be the stuff that we'll be talking about predominantly today. But it also covers a lot of bits about the connectivity, the internal security of European citizens. It contains a governance framework and a way of dealing with disputes that arise under the Trade Cooperation Agreement. A big document and an awful lot of it in there, but I think it's really worth taking a moment just to focus. If we flick onto the next slide, just take a focus just for a moment to see what isn't covered by the agreement. The first thing to note that this really doesn't replicate what went before. So I think when it was first announced, there was a lot of great excitement saying, oh great, okay, well we can continue to trade in the same way as we can. That is not the case. Okay, so in pre-Brexit, obviously, if I had to get goods from the UK to another EU member state, I would load them up on a van and I could drive them straight there. That's no longer the case here. And as Joe will be explaining later, although there's a lot within the Trade Cooperation Agreement which is massively helpful, there are going to be some frictions. You're still going to need to do export declarations. You're still going to need to do import declarations. There are still some bits around services that are still a little bit confused. That's still there. There's no comment in the Trade Cooperation Agreement on financial services, for example, and the so-called passporting of financial products from the UK into the EU and vice versa. And if you're wondering why the government has been a little bit chary about changing things too quickly, I suspect that they have to have a wary eye on that because negotiations are ongoing with that. So really important to focus on. No automatic recognition of professional qualifications. So those of you with professional qualifications won't be viewed as professional when you go to the Europe, which is a little disappointing. But it's but that's where it is. So if we flick on to the next slide, we'll talk a little bit about exactly what this means in terms of international trade. One of the most trumpeted elements of the new trade agreement is the fact that it sets a zero tariff, a zero quota on goods moving between the UK and the EU and vice versa. What this means is that there is potential for customs duty on these things. So their goods are being imported and they are being exported, but there will be no customs duties on those goods. There can still be excise duties, of course, which are completely separate, but there'll be no customs duties. It's very important, though, when I say that, to focus in on some of the things that Joe will be talking about in more detail in a minute. That only applies to goods which are originating in the UK and the EU. So don't automatically assume that the Trade Cooperation Agreement will mean that goods going from the UK into the European Union will have zero customs duty on them, and vice versa. It's a little bit more complicated than that, and Joe will talk us through that. But it is high quality market access, and there are some unique elements of the Trade Cooperation Agreement which make it an interesting structure. And of course, it is very, very welcome that we've at least got that element of zero customs duty on goods originating in the UK and the EU. I think rather than keep on talking about the background trade cooperation agreement, couple of personal thoughts really on the political situation in Europe. The relationship between the UK government and the European Union was never going to be cordial post this agreement, and obviously disputes involving the vaccine program, etc., hasn't really helped with things. I think if I was to choose a word that that describes the relationship between the UK and the European Union, I would say poor and worsening. So I wouldn't be at all surprised to see some further actions and further saber rattling on either side to say, well, look, okay, if you're going to act like this, then we're going to do X, whatever that be about fishing rights, or whether that be about financial services, or whether that be about some other things. Certainly, some of the actions of the European Union have been a bit surprising. A little bit of background to that. Having spoken to some of the people quite close to the negotiating teams, the European Union was convinced that the UK was going to struggle a lot in the initial months post Brexit. The pandemic, the global pandemic, obviously has masked an awful lot of that, and has masked an awful lot of the political agenda that I think the European Union were relying on. But certainly, it's not the terrible situation that some had postulated, and that is a little bit uncomfortable for them. So let's get out of the weeds of the politics. Let's talk about exactly what happens when you're moving goods around, and then a little bit about services. And I'm going to hand over to my colleague Joe, who's going to talk to us all about that. Joe.
Hi, thank you. So in terms of what's actually changed from a VAT perspective, we would split that into two categories. If you can move on to the next slide, please. And the slide after that one. But introduce that by saying that from the 1st of January 2021, any movement of goods between the UK and the EU will be made under new conditions. So where before we had intra-EU movements, which were a lot simpler from a reporting perspective, because generally they just needed to be reported on a VAT return, we'll now need customs declarations. And that involves the use of a customs agent and various admin and paperwork that just wasn't required before, and obviously in many cases requires the payment of import duty and import VAT, and that either needs to be accounted for at the border or on a VAT return, but regardless of whether it results in a cash flow issue, it certainly results in a paperwork issue. So in terms of imports into the UK on a high level, import VAT can be accounted for on the UK VAT return rather than paid at the border if that option is selected by a freight forwarder on a customs declaration. So there's no cash flow issue there. And in terms of the reporting, that's fairly simple. There's just an in and out on the VAT return in theory, but customs duty could apply. So depending on the nature of the goods imported, there could be a cost there, and that's not necessarily recoverable. When the goods moving between EU countries were moving before 1st of January 21, obviously those customs duty didn't apply, and there was no stuck cost in that respect. Next slide, please. So moving back broadly to the two categories that we would group these changes into, we'd first probably talk about business-to-business supplies, and secondly, business-to-consumer. So starting with business-to-business, if we could go on to the next slide, please. Probably the primary issue we see is a VAT registration issue arising where it didn't before. So before, supposing somebody moved goods from the UK to an EU member state, business to business, normally what would happen is the customer would account for the VAT at their end and no registration obligation would arise. Now, depending on the delivery terms in place, potentially the supplier would need to VAT register in the European country to which it's sending those goods and then make a domestic sale. Or on the opposite basis, an EU supplier, again, depending on delivery terms, which I'll go into in a bit more detail later, would need to register in the UK and account for a domestic UK sale. So it should also, as I mentioned, be thought about how VAT on the import should be recovered. So either it can be paid at the border, and we are still seeing clients pay for VAT at the border, even though they don't have to. I think probably that's because the communication between freight forwarders hasn't necessarily been great in all cases, because actually to account for VAT on your VAT return instead and create that cash flow advantage, the freight forwarder just needs to select a particular box on a customs declaration. So if you haven't talked to your freight forwarders about that, and this is an issue you're facing, we would recommend that you do. Next slide, please. So again, before Brexit, there were a number of simplifications that avoided the need to register in EU member states, or indeed in the UK. So one of those was the call-off stock simplification. So potentially where stock was held in an EU member state, subject to meeting conditions, no registration was required. When a business was supplying goods and installing them for a customer in a different EU member state, again, a simplification could apply in a number of cases that avoided the need for registration and has the customer account for VAT at their end. And triangulation, a little more complicated, but in effect, what that means is somebody in member state 1 can purchase goods from a supplier in member state 2. Those can be sent to member state 3, and suppliers 1 and 2 don't need to register in the third member state of the customer. Post-Brexit, that simplification is gone for any movements involving the UK, and that means potentially if in the UK you buy goods from, say, a manufacturer in Germany and send them to a French customer, you would have a French obligation where you didn't before. Next slide, please. So where I referred to delivery terms, if goods are supplied on a business-to-business basis, now that we're not making intra-EU movements and the movements of goods are imports and exports, delivery terms matter a lot more than they did. So it's really important to establish with the customer, and actually as a customer, which delivery terms will apply. So generally, with anything but DDP terms, we would expect the customer to account for the import of goods into their country and no registration obligation to arise for the supplier. Where DDP terms do apply, we would expect the supplier to need to import the goods into the country of the customer, account for imports and duties, account for any paperwork, register in that country, and then make a domestic sale. So if suppliers have previously operated on DDP terms across the board for commercial reasons, that now creates a potential issue where you end up with registrations, in theory, in every EU member state. And at that point, we would always suggest that if it can be avoided, that DDP terms aren't applied and that the customer accounts for the import to avoid those multiple registration obligations. So the strong takeaway there is just to check supply chains. Consider whether you've created a registration obligation, because if that's the case, then that would need to be regularized. But also, even if that does need to be regularized, consider whether you can change that going forward. And once you've regularized the position, shift your delivery terms so you don't have that obligation going forward. If you already have an overseas VAT registration, it's important that you check that the terms of that haven't changed. So a number of countries, probably half of the EU member states, are now saying that a fiscal rep's required. And what a fiscal representative does is takes joint liability for any taxes due in that country. Previously, when the UK was part of the EU, that wasn't required. But now that will be required in, as I said, these sort of 10 to 15 countries. And that will result in extra cost, extra legal obligations in those countries. So do just check that those overseas registrations are now compliant. Next slide, please. So in terms of B2c sales, or indeed customs considerations for both B2c and B2b sales, if you can move on to the next slide, please. Broadly, the main issue is in terms of, you will probably find with most B2b sales, if you can agree your delivery terms properly, that your customer will be prepared to import into their territory. And that's important, as I said, to avoid a registration obligation, but it's also important because the legislation in place across the EU requires that a non-EU business importing into the EU has an establishment or create or appoints a customs agent that's prepared to act as what we would call an indirect representative. And what that means is they agree joint liability for any customs debt. Now, the issue that we're seeing there, and this is something that's coming up again and again, is it's not just as simple as creating an establishment. From a VAT perspective, that's kind of a matter of fact whether a business has an establishment or not. So you can't just set up a local post box. The activity in country would need to be such that there would be deemed to be an establishment. And you may find that your freight forwarder is not prepared to act as an indirect representative and agree joint liability for any customs debt. So it's really important that those conversations are had, that it's agreed with the freight forwarder that they can act in that capacity, because what we've seen where that hasn't been agreed is goods getting to the border of certain EU countries and not being able to import into those countries, which is obviously a massive issue when your customer's waiting for those goods. So key point there is think about whether there's any establishment there, potentially not as a non-EU business. And if there's not, then talk to your freight forwarder about next steps and whether they can act in the capacity of indirect representative, just to make sure that you're not going to have any issues when you move your goods into those local territories. There may be some EU countries that don't enforce these rules, but we're certainly seeing in Western Europe in particular that this is coming up again and again. Next slide, please. So this slide just defines a little bit further what constitutes an establishment. So I won't read that out word for word, but you'll see that actually it's not necessarily a yes or no answer, that what we would deem to be an establishment from a VAT perspective broadly is where necessary human and technical resources are permanently present and through which a person's customs related operations are wholly or partly carried out. But in a lot of cases, it's probably not straightforward, and that takes some thought. If it was straightforward and an establishment was in place, potentially you would already know that. We wouldn't have this issue at all. So it's worth considering just by virtue of your activity, have you created an establishment? Because while that resolves potentially the customs issue from an import perspective, that potentially creates local tax issues, which would always be the case even prior to Brexit. So if you haven't thought about establishment before, now is the time to think about it. Next slide, please. So in terms of B2c supplies, this is slightly different because, as I said, where you have B2b supplies, what we've seen to date, obviously with intra-EU trade, is that there was no reporting required of the supplier. The customer would just account for the movement into their member state. And normally that would be agreed and that would be fine from a commercial perspective. On a B2c basis, that's not actually possible. The customer can't necessarily account automatically for the movement into their territory. But if you go to the next slide, please. So before Brexit, we had a simplification in place that meant that you could, when you're making sales to private customers across the EU, there was something called a distance selling threshold. So as long as your supplies to a customer in any given member state didn't exceed that threshold, and that's set by each member state, that could just be accounted for from the UK. Once that threshold was breached, that meant that the UK retailer had to VAT register in that EU member state. But the point was that the simplification meant that if you're a supplier that made, say, e-commerce supplies, and you had multiple customers in multiple member states, but those supplies per member state weren't necessarily particularly high value, the registration obligation was avoided. And there wasn't any obligation to pay customs duty or import VAT because the goods were in free circulation in the single market. So it was very, very straightforward. The only thing required there was just making sure that the threshold hadn't been breached. If you go on to the next slide, please. So in some cases, even if that threshold had been breached, then the retailer could require that the customer acted as importer. So this would be where obviously we had an export from the UK and import into the EU. The UK retailer would zero rate the export of goods. Import VAT and customs duty is payable by the private consumer, and the UK retailer won't need to account for VAT or customs duty in the country of the customer. So you are probably seeing in the media a lot that customers are saying they've bought something from whichever EU member state, and they're suddenly stuck with a huge bill at the border because they need to pay import VAT to get whatever they've bought. So what they thought cost £100 potentially costs £130. So from a commercial perspective, although that's easier for the retailer because it avoids the need to register locally, from a consumer perspective, that's quite difficult because actually a customer doesn't necessarily want to go through the process of self-accounting for that import into the UK and pay those extra charges. Go to the next slide. Thank you. So, as I said, if the retailer thought actually from a commercial perspective, or thinks from a commercial perspective, this doesn't seem right, it's not fair for the customer's not going to appreciate this, the current option is that they zero rate the export of the goods from the UK. They then need to pay import VAT and duty in the country of the customer, and then make a domestic sale in the country of the customer. So what we end up here, because that distance selling simplification that was in place prior to Brexit isn't there anymore, that actually from a point of zero, if the retailer is acting as importer into the customer's country, they will need to register for local VAT. So where before, for low value sales, we ended up with no registrations across the EU potentially, we now end up in a position where either you have a customer who has to account for the import and they're not necessarily thrilled about that, and obviously it pushes up charges, or you have a retailer that needs to account for VAT in a local territory and ends up with multiple registrations. So if you go on to the next slide, please, there is some relief here in that after July 2021, the import one-stop shop scheme comes into effect. And what that means is a UK retailer can choose to register in one EU member state, and it can, for imports of goods that are worth less than €150, it can file a monthly return in that EU member state, but account for all EU sales on that single return. So there is a benefit there in that, as distance sales applied before, you're only having to account for sales in one EU member state, but obviously, as I said, that only applies to consignments less than €150. It may be that there are a lot of retailers that can benefit from that if they're selling B2C, but it would need to be monitored in terms of making sure that sales under that value are accounted for, potentially under this scheme in an EU member state of choice, but any supplies made for over that, potentially resulting in a VAT registration obligation in that country. So if you go to the next slide, please. So I will hand back to Glyn at this point, just to, I guess, summarise what we see from a high level as the key issues here, beyond what I've talked about, and then we will come back together to answer any questions.
Brilliant. Thank you very much for that, Jo. Yeah, I mean, it's those changes are mild, but they are very, very fundamental, and particularly in the ones involving B2C have been extremely painful for an awful lot of people. You would have seen messages in the press about M&S struggling even, so it's not even just the small people. A few words on services. I think initially most people took the view that the supplies and services between the European member states and the UK were likely to be unaltered. There is one area that I wanted to highlight really. Well, a couple of areas really. The first thing I would say that even if you are a service provider, don't forget you are likely to be moving goods at some stage. So it is still important to have some understanding of the movement of goods. So that's the first point. The second point is that across the European Union, there is an optional series of rules known as the use and enjoyment provisions. And what those do is they effectively say, well, look, if I'm selling services from country A, let's say pick one, not entirely at random, Spain, and I'm selling it to somebody in another EU member state, normally there'll be no VAT. So if I'm selling services from Spain to the UK, you would not expect VAT on that. But if those services, are ultimately to be used and enjoyed in Spain, then actually we're not going to zero rate those supplies to the overseas supplier. We're going to say that they're subject to VAT in Spain. Now, the reason this is relevant is that normally those rules make a differentiation. So if you're a Spanish supplier and you're supplying a service to a Portuguese company, and the service is used in Spain, that won't necessarily be caught. However, if you're supplying that same service to somebody who's not within the European Union, which includes the UK now, then it will be. So if you've got any situations where you are buying in services from other EU member states, particularly Spain is particularly bad for this, but all of them have some type of use and enjoyment in limited provisions. And those services are ultimately going to be used locally, and I'll give you a couple of examples in a moment. Then you might need to consider whether you have an issue with local VAT. And the important reason then is you need to obviously think about how you're going to recover that VAT, because you don't want it to be a cost. So one of the big ones that hits a lot of our clients is advertising, and particularly again in Spain, maybe. So there's a use and enjoyment provision on advertising in Spain. So if you are buying in Spanish adverts that are running on Spanish TV, then that's going to be subject to Spanish VAT, regardless of the fact that you're not established in Spain and you're established in the UK. Another one I came across recently, a client of mine had a shared service centre in Spain. It takes all the costs into the UK of running that shared service centre, and then it redivides them out to the operating companies around Europe. One of those operating companies is in Spain. So obviously the services that are carried out in Spain are used and enjoyed by the operating company in Spain, and therefore, even though they get routed through the UK, and therefore there is now Spanish VAT on them, so they need to either change their situation so it doesn't go through the head office anymore, and just goes direct to the Spanish company, or they need to put into place a methodology of recovering it. And those are the big changes in services. There are quite a few little subtle changes. One of the Section 7A in the VAT Act has been amended by the border operating model, and that talks about situations where you are a business or a non-business person. I don't think we've got anybody on the call who's a charity, but it might be worth just considering those rules. So if we flick onto the next slide, what I'd like to do is talk about two very, very specific issues on goods. Joe has already touched on them, but I want to really focus in on them, because these, I think, are the biggest points of misunderstanding that I've come across. The first is the rules of origin. So the Trade Cooperation Agreement says that we will charge 0 tariffs on any goods that originate in the UK and go over to the EU. Say, and the other way around, but it's easier to look at it one way round at a time. But that only applies if those goods originate in the UK. So if we think about that for a second, there are basically 4 scenarios we need to think about. So if I'm manufacturing goods in the UK and I'm manufacturing it all from UK materials, that's fine. That will definitely be under the Trade Cooperation Agreement, and there will definitely not be any duty cost on those goods going from the UK to the European Union. More likely, though, I've bought in goods which are manufactured, say, in China. So if I bought in goods that are manufactured in China, bought it into my stock in the UK, and then I make a sale into the European Union, and I then sell that, the Trade Cooperation Agreement will not apply to those goods, because they do not originate in the UK. And insufficient work will have happened to those goods to make them UK origin. If you think about the third scenario, which is where I manufacture goods in the UK, but I use some materials which come from China, from Malaysia, from elsewhere. And that ends up in a really, really complicated situation, because the goods are undergoing a manufacturing process, but it really depends on how much value is being added to those goods, whether we can then claim UK origin, or whether we suggest that those are not UK origin and therefore not under the Trade Cooperation Agreement. Now, I'd love to be able to tell you what the rules are. Unfortunately, every single line of the tariff has slightly different rules as to how you make that calculation. So if you've got that situation, it's really, really important to have a look at it. And the reason it's important is that in the trade cooperation agreement, there's a presumed knowledge clause, which gives you automatic rights to use the trade cooperation agreement to zero duty products. But it also contains the right of any EU member states to insist on an inspection to see where those goods did actually originate from. And what that means is if you say that these goods are UK origin and you send them to your French customer, your French customers gets an inspection from the douanes, and the douanes look at it and go, oh, actually, we're not happy about the origin. We don't think these originated in the UK. Therefore, we're going to ask the UK customs to come and knock on your door and find out. If you can't show that those goods do originate in the UK, what's going to happen then is that the douanes are going to say, okay, these goods should have been subject to duty, and they'll fine your French customer. Your French customer is going to do one of two things. They're going to come after you and say, well, look, you told us they were UK origin. You completed the export declaration as a UK origin, and therefore we're not happy with you, and you need to give us the duty. Or worse still, they might just walk away from you. So that is a real key issue, and it's a very, very real one. A lot of people got very, very excited about the trade cooperation agreement and thought that just meant that there was never going to be any duties. That's just not the case. The other weird one is actually what did happen to Marks and Spencer with their Percy pigs, if anybody was reading the newspapers in early January. Goods that go from the EU into the UK and go back into the EU again end up in a very, very strange world, partly because I think the trade cooperation agreement was drafted very, very quickly without the usual kind of clauses. But what could happen, and what has happened, is that goods that are manufactured in the EU come into the UK. Okay, they're EU origin goods, and therefore the trade cooperation agreement applies. The goods come into the UK, and then the goods go on from the UK onto, say, the Republic of Ireland, and they go back into the EU. What happens there is the EU to UK movement is fine. That's zero duty because the trade cooperation agreement applies. When they go back into the EU, those goods have lost their EU origin because they're coming from the UK. And when they come from the UK, they're not actually had enough done to them in the UK to get UK origin. So that they even though they're clearly from Germany in the case of Percy pigs, they're coming into the UK. They're no longer EU origin. They're no longer UK origin. It falls outside the trade cooperation agreement, and therefore it falls within the normal duty rules, the WTO rules that everybody refers to. That is really, really weird, but it needs to be managed. Not so much just because of duty costs, but also because of the delays. Obviously, the poor people in the Republic of Ireland just had to do without Percy pigs, which is a horrible situation. So be wary of that one. If we move to the next slide, we'll talk about the other big issue. The other big issue, and Joe's covered this in some detail, so I won't waffle too much, but that is this establishment issue. So in order to be declared as an importer into the European Union, or the UK for that matter, because we copied the customs rules into UK law, you have to be established either in the UK or in the European Union, depending on which one applies. If you're not established, you need to find an indirect representative who's going to be jointly and severally liable to you. And as Joe says, that can be expensive. But worse still, in the UK, there just simply is not a market. So all the freight forwarders in the UK, this is a rule that's always been there. It's been there since for nigh on 10 years now, but nobody's ever applied it in the past. So nobody really cared. Nobody really got too excited about it, and I gather that an awful lot of entries were fudged to make that the case. But the market for freight agents in the UK is such that most of them are not going to be an indirect agent. because obviously they don't want to be jointly and severally liable for a potentially massive debt. They're certainly not going to do that for their normal, 50 euro a transaction kind of cost. And because this is a new thing, the market hasn't really reacted to create people to go and be your indirect representative. So I think I just wanted to mention that to you, and that is the main driver of an awful lot of restructuring around the place. Because you're looking at situations where we're moving goods overseas. If we're moving those goods to businesses that are not sophisticated buyers, so hospitals, charities, this kind of thing, we're having to compete against local goods which look simpler and look cheaper because there's no declaration required. If we then think, okay, well, we'll import them, we may not be able to do so, and we need to put something in place to do that. So if you're in that situation, do have a think about that, and don't just assume it's always going to be all right because it was all right in the past. I act for a large number of US businesses, for example, who have always imported goods into the UK without having any kind of establishment here. They're all having to look at this again and think, well, actually, do we need an establishment? Do we need an indirect representative? Should we change our terms and conditions so that our customer is the importer? Do we have another company that we can possibly do the import through? So that's the kind of thing that would go. So I think that kind of brings our little presentation to an end. Do we have any questions? In fact, shall we move on to the last slide and say, do we have any questions? There you go. That's a rather nicer picture of Joe than it is of me. Joe, you going to join us?
I'm here.
Fantastic. Thank goodness for that, just in case I've got some questions. Now, what I didn't do is tell people how to use the question and answer app, which might be why there are only a small number of questions. At the bottom of your screen, you will find a Q&A button. Please feel free to type any questions in that, or just send us a message in some way, or even just raise your hand, and we'll try and deal with those questions as we go through. In the meantime, I've got a question for you, for Joe. Joe, what is the key issues for your clients that you've come across over the last 5 months since Brexit?
So I think for me, I have a number of clients who are VAT registered in various EU member states and are moving goods from the UK. And what I'm seeing, firstly for movements of goods from the UK, but also for intra-EU movements, is that local tax authorities, particularly in Western Europe, are now very interested in the valuation of goods on those import declarations and the commodity code on which that valuation is based. So for anybody who's not familiar, a commodity code is an 8-digit code, and it effectively categorizes the goods and it informs the default duty rate. And whereas before we did use commodity code for intrastat declarations, which were for movements of goods intra-EU, and they did matter from a statistical point of view, but mattered less in terms of actual cost. Now they're potentially affecting the amount of duty and VAT due, and tax authorities are much more interested in how the client that's moved those goods, how they've got to that commodity code, and what the reasoning behind that was. And it just doesn't appear to be acceptable to say it just looked about right. When I looked at the categorization, they want proper evidence of the breakdown, to the extent that with a pharmaceutical product I've seen, they want to know the ingredients, the makeup of the product, how it's manufactured, in order to determine if that analysis was correct.
That's really interesting, Joe, and I think that valuation point is one that I didn't expect to be such a big issue. Valuation, even for goods under the trade cooperation agreement, because you're filing an export declaration, it's absolutely essential that the valuation is correct. Now, in customs world, valuation is carried out in a very, very strict and formal way. It's okay if you're selling goods on the open market, then it's very clear that the sale price is the price that applies, unless there are any other costs like buyer's agent fees that get added to that cost. So that's very, very clear. But actually, when you look at it, if that isn't the case, if you're moving goods between group companies, or you're moving goods between associated companies, then there is a very, very strict set of rules which say how you carry out that valuation. And what I'm finding, and what I found really quite astonishing with my clients, is that actually so many of them had valuation issues. So they were saying, well, okay, well, we just move goods in between our group companies, and then we'll have a transfer pricing adjustment down the line. Well, that could be okay, or it might not be okay. Most transfer pricing adjustments that apply to the value of goods that are being imported and exported do lead you to a position where you have to refile the customs entries, which is expensive. So there's, for the first time, this real sort of drive to get the valuation right the first time round. Also, you're basically just painting a big bullseye on it, saying, well, look, guys, actually, the situation is that our valuation isn't the correct valuation for these goods. Which also causes a certain amount of tension. So for the first time, many of my clients who've quite cheerfully been sending goods between group companies are sitting there thinking, well, okay, we need to come up with a formal valuation process for these goods. I mean, have you found that, Joe?
Yes, and I think also in terms of delivery terms, where goods were moved intra-EU between associated entities, whenever I'd spoken to clients about delivery terms before, they'd said, well, it's intercompany, so we don't need delivery terms because it just is what it is. And obviously now that matters more, because even if it is intercompany and between associated entities, then if those are distinct legal entities, then if the delivery terms aren't right, then those groups end up with registration obligations they just weren't expecting. And I think in a lot of cases, the delivery terms haven't necessarily even been considered. So there aren't actually any delivery terms, and that becomes very complicated in terms of accounting for those movements.
Brilliant. Well, we've got a question for you, Joe, from one of our listeners. The question is, and I think it's a rather good one actually, is hang on, let me read that again. Sorry. Go on, Joe. Talk a little bit more while I get this question framed correctly for you.
Yeah, I would probably just add just on what I thought was particularly interesting on the queries rising on valuation and commodity codes is, to a degree, I would expect that for movements that involve the UK, because that makes sense. Because if you're moving goods from the UK to the EU, there's an impact of that commodity code and valuation. But I'm also seeing where my clients are moving goods intra-EU, the tax authorities are raising the same questions. And it seems to be that because this has been triggered by the UK leaving the EU, they now want to know how goods are being valued for intra-EU movements, which seems very odd, because in theory, that doesn't really matter. So it's interesting that the tax authorities, I don't think it's just affecting UK trade, I think it's affecting EU businesses. Yeah,
absolutely. And certainly you're also seeing some of the European member states customs staff being very, very formulaic in the way they look at these things. Obviously, there is an emotional angle to any separation, and you know, Brexit is no different to the rest. And actually, an awful lot of the guys seem to be a little bit hurt. The question, I've managed to frame the question now a little bit better. We've heard that that there is a problem recovering VAT if we do not own those goods at the point of import. I think that means. Joe, have you come across that?
Yes, to varying degrees. So from what I've seen, most EU tax authorities say if you have the right to dispose of goods as owner, then you're entitled to import VAT recovery. But how that's applied across the EU varies, because in some cases, the local tax authorities will insist that the person who recovers the VAT is named on the import declaration. And they don't, even if they're the owner of the goods, if they're not named on the import declaration, they're not having the import VAT back, because I think there then potentially becomes a bit of an issue in terms of proving ownership. But then on the flip side of that, I'm seeing where businesses are named on the import declaration, the tax authority is still saying, well, you need to prove that you own those goods. So although in theory the rule is fairly straightforward in that if you own the goods, you're entitled to the import VAT recovery, we've got firstly the import document issue, and secondly potentially being able to prove ownership of those goods, which isn't necessarily straightforward, because if you have a chain transaction where goods are moving from supplier to supplier, potentially to customer, who owns those goods when? Is that at the point of import? And tax authorities, from what I've seen, are being much more particular on that and wanting more evidence than I've seen them want in the past. Have you had the
Yeah.
same?
Yeah. Funnily enough, I have. Yeah, and in the UK more than overseas, actually. The UK actually released a couple of business briefs a little while ago, saying that, look, to make it abundantly clear, if you do not own the goods, you cannot recover the VAT. Now, if you combine that with the establishment thing that says, actually, we can't import goods if we're not established, so therefore we've got a subsidiary in the UK, they can import it for us, can't they? Well, they can, but if they've then got a VAT liability to account for VAT under the PVA, sorry, the postponed VAT accounting, and we've got that situation again where we don't own the goods, but we've got a VAT charge on those goods that potentially we can't recover. Now, the UK did release a statement that said that we've changed our internal manuals slightly. They never quite admit they're wrong, do they? But they did say that they have changed their manual slightly to say that actually, if you do have the right to dispose of those goods as owner, we will treat you as being able to recover the input tax. The bit that I'm struggling with a little bit is it seems to be a bit of a difference in the narrative when you talk to the revenue policy people. They're saying, well, look, actually, what we mean by that is, providing you've got sufficient sort of control and interest in those goods, you can recover it. But the words that they put in their manual are that you need to have the right to dispose of them as owner. Now, I'm never entirely sure that I understand what that phrase means. If I'm absolutely, I know it comes from the EU law, and I've certainly read it before. But I can see situations where, for example, call-off stock in the UK. So if you've got a UK business that has stock in their premises from the EU that they don't own at that point, and they've imported it into the UK, can they recover the input VAT? Is the question. And I think, I think the change to the manual was intended to cover that kind of situation, but it doesn't really, if you think about it, because you don't own the goods, you don't have the right to dispose of them as owner. You might be able to buy them and then dispose of them as owner, but at that point you don't, and neither do you know that you're going to, because you might just ship them back because you never found a buyer. And that situation, I think, is rather awkward, because it does leave you in that kind of world where you've got to kind of trust the revenue or try and get them to provide you with a ruling, which is not always the easiest thing, to say that you can recover that. And I think that's I've certainly got a live issue with that at the minute, and it's hard. It's really quite complicated.
Yeah,
it's really quite
agreed.
complicated. So
are you seeing any other particular issues with your clients that we haven't covered?
No, I think we've covered most of the ones. I mean, the big ones, and I think the big time bomb for me is the origin. Because when I talk to clients about it, they go, yeah, we're fine with the origin, and then actually when you look down and think, well, actually we ought to put into place some kind of process to capture proof of the origin of these things. So although it's not required because there's a presumed knowledge clause in the trade cooperation agreement, I think it's very wise to do so, because you might need to.
Yeah.
And when you start looking at that, actually some of those supply chains are ferociously complicated. The amount of work you do could vary. The goods can come from all over the place, particularly with the trouble at the moment with shipping goods and the shipping containers all being in the wrong place because of the pandemic. It is causing an awful lot of pain and an awful lot of confusion. I'd say that probably underpins 90% of the issues that we have on B2b. And B2c, and the new changes to the B2c rules, which say if it's less than €150, you don't need to you don't make an import of it. It's actually effectively there is no simple digression, but there is no import if it's B2C. You account for local VAT. That has been put in very strangely in the UK. So in the European Union, you either have to provide the VAT number of the recipient of the goods to say, well, look, actually, we're going to import it because here's the VAT number, or you have to account for it, or you provide your VAT number and you say, okay, I'm counting for it as output tax. In the UK, that fail-safe isn't there. So it's covered by that. So you have an obligation to register for VAT here, but if you haven't registered for VAT here, there is no real catch-all. So that's another one which is causing a certain bit of toothache around the place.
Yeah.
So we've only got a few minutes now. Does anybody else have any other questions? So brilliant. Well, I'm going to probably bring this towards an end. Joe, what are your 3 takeaways for business at the minute?
So my recommendations would be check your delivery terms for all your supplies and purchases, and make sure that if you have created a registration obligation, you put that right, you regularize it, but you amend your delivery terms so that things are easier going forward. My second point would be speak to freight forwarders. Make sure if you're importing into the EU or the UK that the freight forwarders are either acting as your indirect representative, or you're very clear on the requirements around establishment. And as a third point, I think I would just say, think about the value you're attributing to your products and how you get to that value, because it's not just about underpaying due to your VAT. You may be overpaying it because a code's been automatically allocated at some point in the past because it didn't really matter, and actually there could be a saving there.
Yeah, I think that's absolutely key. What I would say actually reflects that rather too closely, actually. So at risk of repeating what you've just said, check the delivery terms, but also check your contractual terms. I have come across 3 or 4 situations where you've got 3 separate situations. You've got an Inco term that says, we delivered duty paid. We've got a contract that says it's effectively delivered at place. And then we've got a process and procedure which seems to suggest that it's something else entirely. That will become very, very dull and very old very quickly. Think about process. Look at your processes and your basic procedures. Make sure you're in a position to pick up the PVA, particularly if you don't do an awful lot of it. I know that if you have your VAT returns done elsewhere, you're going to have to make sure that these people, that whoever does your VAT return, knows that you've imported stuff. So in the old days, you used to get a VAT certificate that said, here's your C79, here's your input tax you need to recover. Now, the only trigger is the knowledge that you've imported something, because you have to do both the output tax entry and the input tax entry. In order to be compliant, you're going to need to do that. And don't forget, MTD will make that particularly complicated to do. So do have a think about that, and do make sure that your guys do know what they're doing and they're able to capture this information. It's been a big problem for some of our compliance clients. Just to find that information, they just didn't know, and when we asked, they said, well, how do we get proof of that evidence, etc., etc. It's quite difficult. Think also about process and origin would be my final one. Don't assume there's a 0 tariff just because it's going from the UK to the EU or vice versa. Have a think about your tariff, have a think about how you're going to prove those origin. Put yourself in a situation, just cast your mind forward and think, what would happen if I was in a situation where the revenue came up tomorrow and said, prove to me that those goods originate in the UK? That's much easier if you have a process to find that stuff. To try and do that 6, 8, 10 months down the line can be very, very difficult indeed. And it's a painful process, and it's a painful process involving your customers, which in turn will hit you in your balance sheet. So those are my thoughts. Joe, thank you very much indeed for talking us through that. I certainly enjoyed it and certainly managed to follow it. Thank you very much to everybody who managed to hang in, and I think everybody did manage to hang in. So great to see you all. Thank you very much indeed for spending the time with us this morning. Do feel free to ask questions or send us a note afterwards. Our details are on the slide, so you know, if you've got a question, get it out there and we'll see what we can do to help you. Look forward to speaking to you all sometime in the future.
Thank you. Bye.